Hi guys, and welcome to today's video. In this video, you're going to learn how to profit even if you miss your entry. So no more FOMO, no more fear of missing out. You know how it is when you've planned your entry, the market's gone without you, you've missed that entry that you were planning, and you're thinking, oh no, oh gosh, you start blaming yourself, you start having all kinds of thoughts running through your head. This is what to do in those scenarios. So let's walk you through it. I think you'll be glad to know that there is another way, okay? You don't have to go through all that hassle and all that mental anguish of missing out, and not be afraid to even miss out if the market doesn't provide you with the opportunity. So this is what typically happens, doesn't it? You have a plan, you have marked out your zone, your entry here, you have a level, you're thinking about entering it, and then what happens? The market spikes it and moves away without you, and you go through this kind of motion, and you may pull out all kinds of words, and then you're just thinking, oh no, what have I done wrong? And what am I going to do next? So you don't need to go through this process. What do you do instead? Well, what it requires, first of all, is a mindset shift. So the shift is from being in that low place to being in a much higher place of, wait a minute, is this really true? Is this really the case that I've missed out? What's my worst fear? Am I really not going to be profitable, not going to be a good trader because of this? Maybe not. The market is always going to produce more and more opportunities on a regular basis. Basically daily if you're a scalper, and maybe a few times a week if you're intra-week, and maybe a few times a month if you're a swing trader. So it'll always be there. So what do you do? Well, first of all, you let the market go. So never chase it. If it's gone, it is gone. Okay? That's the first thing. So let it go. It will do what it wants to do. There is no point to try to desperately cling on to it just because you think, oh, well, maybe I should do something about it. I can't let it go without me. So let it go. Completely release it. And secondly, again, as I was saying, a mindset shift, rethink. The way to rethink it is there more momentum left in this move? Is there more left? So if you look at this scenario, in this case, where we were thinking of entering in here, we missed the move, market is shot away, and now rethinking the scenario in a different way, looking to the left, looking at a much bigger picture, which you'd already have in mind. And the bigger picture is there more left in this move? Can I still make use of it if I rethink the scenario and replan it? How do I go about it? But let's say in this case, we were looking to enter here, and we were thinking that the market will head to the next high, and that was our TP point. If that's the case and the market is shot away, the next thing that we would look at is where between here and here in this whole space can we make an opportunity, can we have an opportunity, a possible opportunity to buy without jeopardizing the risk to reward and without entering on a low probability scenario? How do we make use of that? Well, if the answer is that yes, we still have this space, so in this case we are about this level, so from here to here we still have this move which can still complete. Now, the way to deal with this is, if you have missed it, then obviously you would have to reconsider the way that you are going to enter, the way that you're going to trade, in order to be flexible. How do we do that? Well, first of all, first option is you use the next swing in your time frame. First of all, if you have seen this table, if you have not, what you need to do is to look at the video that is about using multi-time frame combinations, multi-time frame analysis. And in that video, I'll talk about the combination of higher and lower time frame. So let's say in this example that we're looking at, I am analyzing on the weekly and I'm entering on the 4 hour, and the 4 hour is the one that I missed the entry on. So if that's what I missed the entry on, so let's say, for example, let's do it again. It was something like this. It was our level. Wanted to do that. Now we missed the market. And what we have next is we want to see the next swing point on the 4 hour. So the 4 hour, which is our entry, would be the next swing point. So that swing point would be the next entry. Now, obviously, that may take some time to develop because it's on a 4 hour basis. However, there is another way if you combine the time frames, and that is to use the lower time frame to find the next best entry. Now, of course, a lower time frame would be more of a intra-week or intraday basis. And if you use that, you'll also need to lower your expectations. So it'll be a quicker move. So you can use a combinations table here, the table that we've got here to reference, and then you go to the next lower combination down. So let me talk about how to do that if you are not using the same time frame that you are trading on. So in our scenario, if we've missed the move, which was here, and we are looking at the next possible move, if you want to capture the move sooner, then if your entry was on a 4 hour, then you take that 4 hour and you make that 4 hour your higher time frame, and then you enter on the 15-minute. So you use the 4 hour candles, and then once that analysis is ready on a higher time frame, you can use the 15-minute as your go-to point in order to enter. So that next lower combination down. So from 4 hour, you go to H4, and then if you usually use H4 and you enter on the 15-minute, then instead of the 15-minute, you use the 15-minute as your higher time frame and the 1 minute as your low time frame entry. So let's say now that you used the daily as your analysis and then your 1 hour as entry. Now, instead of a 1 hour as entry, you use the 1 hour as your high time frame analysis and then the 5-minute as your entry. And now let's go through an example. So this is actually an example from last week. So here is an example from last week, which is still running at the moment at the time of this video. And the example is here, quite simple. However, we're going to break this down. So what we had is we had this level here as the one we were looking at reversal from. We had this reversal, and here looking on the 4 hour as our time frame for entry, meaning I was analyzing this on the weekly. I was looking at this level to reverse from, and these were the two scenarios I was waiting for, either a break or this lower scenario and then moving higher. And what happened is, as you can see, we went right into the level and through it. This was our trigger point, and the invalidation of the trade was the low. So we had that, and we had a big move up. The market went in. This was just where we're looking to get in. And then we shifted away. We really moved away with momentum with this engulfing candle. So this was the entry idea. And the market quickly moved away from that. If this is missed, this is where you'd be thinking, oh, well, I missed out. Oh, no. Again, what is happening? All going through all these emotions and thoughts in the head. How to approach this issue? Well, on the left here, now what we have is this, which is the 4 hour entry, now becomes the 4 hour higher time frame. And here to the right, which is the same chart, on the 15-minute, the 15-minute becomes the entry trigger. So what do we see? Well, we had the market run lower, and then we had, boom, that move higher, that real move higher. Now, as we are higher, at this point in time, thinking, right, the move is missed. I missed this entry at the low here. Now, what do I do? At the time that this move happens, you could then go into the 15-minute or wait for the next 4-hour swing, which is what we were saying earlier, in time, as time goes on. So the next 4-hour swing would be something like this. Yeah, it would be a big swing. However, we're not there yet, and we have just missed this move. So then what do we expect? Well, we expect that the market will create some kind of pullback at some point in the next day, tomorrow, whenever this happens, and then head higher. And where do we head higher? Well, at least to the next levels high. But of course, our ultimate high, which is still remaining, is this high up here. And that is on the higher time frame. So we're using the high time frame as the guide, and then the lower time frame to trade in between, piece by piece, to that level. But on the lower time frame, this will be the first initial target. Now that the move is gone, missed it, fine. What is the next point of reference? What is the next point that we should be interested in? Right, we're thinking, okay, missed it. Okay, reassess quickly. Let's see what is the next opportunity. Where would the next opportunity lie if there was one? Well, if we look to the left, what we can see is there is a bit of a level here with all of these. And now if we stretch that to the left, we can see that here, this level would be the place that we'd be interested in. And that would look something like this. So if I just run this forward a bit, you see we have that retracement on the 4-hour, we dip into it, and then we shift away. So this is here on the right hand side. This shift is the same as this 4-hour on the left, and that would be an entry. And here you've got in one 4-hour candle the next target hit. If you're doing it on this lower time frame, then of course you have to lower your expectation. You can't expect that, oh, because I'm going to say that because we shifted here, we're now going to go right up here. So of course that would be a great risk to reward trade there, but can't expect that to happen. What happens then? Now let's say you have another scenario. Let's say that you missed this low. So this low here that we wanted to catch, we missed that as well. Well, what next? Well, this is it again. We do the same thing again. Now we have this swing formed, and now we have the market shifted higher. We moved higher still, created a new higher high. What do we want? We want to see a retracement. So this first level has been hit. What would be the next level up? The next level would be reference to the left level here. So looking again at the market, what happened? It shifted higher. Yep, it shifted higher. And then what do we wait for? After we shifted higher, another level. So where's that other level? Looking down on the 15-minute is here. So we trade into that level. Looking here to the left on the 4-hour, the candle traded into that level after that 4-hour close, which is right here. And then once we had that, this was the next opportunity here. And then the market continued heading higher because we have the bullish bias. We don't want to be selling this market. We're just looking for buys. And you can see that we had the move higher. However, we do need to lower our expectations. So here we are, and the market is hit. Now, of course, I'm being picky with choosing the chart, but this is one that we are actually looking at live during the week. A few things to note for this kind of setup. So first of all, if you're considering that you're re-entering at a different price point, the invalidation point or the stop loss point would have to shift with the market. So as the market heads higher, we had this move away. This now becomes the low, and then we look to enter once this low has moved away, has confirmed, has stayed, then this low now becomes the invalidation point, and therefore any retracement, any kind of level that you're looking for here to enter on here, this would be the reference point. It would not be this, and it would not be this low. It would be the last low, because you're looking at the higher time frame being the 4 hour. So the 4 hour would be the reference point, and then you look to 15-minute as your entry trigger. And bear in mind that this is a shorter time frame, a lower time frame, and therefore your expectations should be lower, because we could always get another retracement, a weekend gap, whatever it is, which may spike the market and take you out, basically. So this is the way to use it, and this is the way to really get another entry if you miss the initial one, which may go without you. However, planning your trade and trading your plan is ideally the ideal scenario. Okay, hope that is clear. Just coming back to our table one more time, so you can remember the time frames. Whichever higher time frame you use combined with a lower time frame, you make that higher time frame that lower time frame, I should say, the trigger, your new higher time frame, if you're looking for that shorter term move or the more immediate move. However, you could just wait, reassess, wait for the next swing on the entry time frame. And that's how you do it. So being flexible is very advantageous here, and really assessing where are we at and what is the market telling us it wants to do. If it's moved away with momentum, created a new low or a new high, and it's already gone, it's really shifted, then the likelihood is you have already missed it, and we now got a new reference point, which is either a swing high or a swing low in the market, and you use that as your reference point. That's that really. So thank you guys for watching, and remember, you can relax because the market will always provide more opportunities. It's just its own fractal nature, and going to go on and on and on and on. That's just how it works. That's it. I mean, there's no fear of missing one bus, even two buses, no fear of missing out. You can let that go and be safe in the knowledge that it'll come again. I'll see you guys on the next video. Thank you very much for watching. And if you haven't seen the other time frame combination video, then have a look in the playlists and the videos on the channel, and you'll find it there. Bye for now.